There's a lot of stuff on YouTube about trading mindset and psychology. I've done interviews before with some of the experts in the field on psychology and mindset, on how to actually become a good trader, how to develop the mindset of a profitable trader. I thought it would be good to do a 1-hour masterclass on that topic. So I've put together the best advice I found from my interviews, people I've seen online about trading mindset, actual tactical advice you can use to become a better trader, and something that you might have a hard time finding on YouTube. So hope you like it. We're going to go through many lessons in this. Make sure you take notes. Watch this at double speed if you want to, so that you're able to go through the 1 hour faster. Up to you. And comment below with your favorite advice. We'll dive right in.
Traders' problem happen. They lose or win long before they start trading. They bring a particular mindset to the game of trading. And if that mindset, if the biases in that mindset don't match up with the needs for trading effectively, they're going to have problems with either getting into trades, blowing up revenge trading, not being able to take profits when they have. It's all over the place. But the main thing, the biggest thing is the attitude toward winning and losing. Recently, I was talking to a guy who just laid down a little over $50,000 to get this complete trader training education, okay, from a very expensive source. But he said, I've got it. I'm going to be incredibly well trained. And while they were in that training, the people who are running this thing kept asking, what is it you want to accomplish? And they wanted to accomplish things like becoming the first billionaire trader, this, that, the other, all these really heavy goal-oriented goals that certainly trading, when you look at trading and you start leveraging it up, you realize, oh my God, sky's the limit with this stuff. And yet, most of the world, and I used to think it was Americans, but what I've discovered, no, it's the whole darn world. We're so focused on winning. I need to win. If I win, I'm going to make money. If I make things happen, I'm going to make money. And the one thing I don't want to do is lose. I don't want to be a loser. It's kind of like in where I played football in high school, there was a big, huge sign in our dressing room. And that sign said, winners never lose and losers never win. And I just want you to see it's a mentality. They bring that mentality about winning and losing into trading. And that mentality is rooted in the ability to control outcome. And when they get into trading and recognize no matter how hard they try, no matter how much money they spend on systems, no matter how much mind control they conjure up, is that they are not in control of the outcome. And that flips people out. That flips the evolutionary psychology that the humans that we're built to be from an evolutionary standpoint. It flips it. And it freaks out that caveman and the caveman living with you and I. And so that's the biggest problem, is the mind they bring to about winning and losing. I promise you. It's, I have never met a really good trader that was not a damn good loser. There is a great book, and I recommend it. I'm gonna slaughter this guy's title, but I think everybody should read this. And it's The Hour Before Wolf and Dog. And it's by an ex-derivatives trader who became a neuroscientist. And what he really did is he examined institutional trading. And he examined the culture that produces the kind of institutional traders that you see. And ultimately, this is when, under big days that, people would get cranked up. The fight flight was just cranked up. They had to go to the bathroom. They had to clear out their gut. They had to do everything like that. They were really getting prepared. And ultimately, what he noticed is that a few guys would have these monster years where they might make $50 million for their firm. And they're the ones doing all that theatrics that you're hearing about. And then there would be also these guys who only made $10 million a year, but they consistently did it year after year after year. The guy that got the bonuses was the guy who hit the home run. Okay? And, ultimately what happened is in 5 years, The guy who hit the home run, the $50 million, was no longer in trading. Yet the guys who were moving along, not making spectacular achievements, but really had the mind for trading, they are consistently giving the kind of profitability their institution needed, okay, to survive, while they look for the next home run hitter. And basically what the guy comes down to is that until that culture changes, you're not going to see the consistent profitability that like is strived for with retail trading. Because, you know, ultimately what I'm looking for are people who are looking to become consistently profitable. That's a big deal, not going and hitting home runs. I could care less about that, because what I know is a lot of guys with small accounts, what they're going to do is they're going to add more risk. And all of a sudden you start seeing this guy go from 5,000 to 30,000, 50,000, 100,000, and he feels he's all pumped up. He's all ready. But what he's also added during that time, he started adding more risk, and he's gotten lucky. And suddenly that risk catches up with him, and he finds a black swan moment and blows everything up. That happens all the time, particularly with people who are getting into trading to get rich quick. And they will look at that risk factor, and they don't understand that risk factor can really turn on them, and it can become very ugly very fast. So yeah, you read about that in institutional traders, but understand this is that institutional traders, they're gone in 5 to 7 years. They don't last long. What you're looking for is a guy who can stay the course and consistently produce money. It's a different mindset, but it's also a different mindset that comes. And the institutional people, they're looking for that home run. That's who they're recruiting for. That's all that stuff. And the retail thing is that you have to overcome all this BS that you're presented with by the trading tradings, and recognize that, no, this is really about risk management, where, you know, you're not allowing your risk to get up too far beyond 1% on any one trade. You would never risk more, because your job is to build that thing over time. And I have a friend of mine, not a ex-client of mine, just sent me his ROI for the last year and a half. And it's 77%, which if you've been around traders a long time, you recognize 77%. That's what the professionals do. They're hitting that. They're hitting any, you know, when you start hitting between 48% and 90% return on investment per year, that's what really good professionals are doing. And what he said is, I had to quit using everything I learned about trading, but what I incorporated was your work about the brain and uncertainty. And I finally came to the moment of where I knew I had to slow down, and I had to quit being this alpha who wanted to win. And I had to become the trader who basically vigilantly waited patiently for the setup to show up, and was undaunted by the wait. I wasn't bored anymore. It was just patience. And then the trade comes. It'll show up, you know, well, depending that you have a system that works with an edge that works, that finds valid setups, and you're hitting an appropriate level of those valid setups. But it goes back to winning and losing. That's what it really, the mind you have about winning and losing. We often believe that, you know, I've got this indicator, I've got these really cool things, and, you know, it's going to give me an edge, and it's going to show me high probability. And what you ultimately understand is that a valid setup is an organization happening within randomness that may or may not play out. You don't know. And you've built a hypothesis around your work about, okay, this one looks like it's a go, it's a valid setup from my rules. But then I have a friend that teaches, and what he does is he says, Randy, once we get into a trade, we have 4 3-minute windows that decide whether or not we're going to stay in that trade. He says most of the time it's the second window that will get us out of the trade, because we don't want to be in a trade no matter how much we want that trade to work. The truth is that once we see that trade not fitting our hypothesis, we want out of the trade at a small loss. Now, this guy that I'm talking about pulls $10,000, $12,000 a day out of the markets. He's good. And yet what you're looking at is that what he's built, and certainly he likes to win. And I might add is I actually have a video of this guy taking his keyboard and hurling it into one of his screens. So this guy could have matched up to the guys you were talking about, blowing up things and things like that. But ultimately, he had to tame that anger, become patient, and basically become, but he could not. He used to use anger as a way of controlling outcome. When you get angry, it's an accelerant, and what happens, you feel, whether or not it's true or not, that you can control outcome, you can make things happen. And what he discovered is no, he couldn't. And he realized that he had to back out of that. And out of that work, instead of becoming angry, he became an incredibly good loser. He did not stay in bad trades. He did not feed bad trades with good money. And at first, there was a part of him that wanted to save that trade, but he came to recognize and learn how to manage that impulse, that that's just simply not the way to win in trading. So that's where the consistent profitability comes in, is that on any one given trade, some guy, I'll give you a good example. I work with Dayton, and he's one of the only friends I have as a trader trainer, but he's very successful. And he has a group of people who would trade around him. And these are like hedge fund managers and things like that. David's been around for a long time. He's got all the attachments of high level success and all that stuff. And he gets into a trade, and as he gets into it, he recognizes it no longer fits his criteria. So he gets out and just thinks nothing of it. The next day, he has several traders come to him and says, David, you just missed a huge move. Man, we made a ton of money yesterday. Man, you should have stayed in there. And David's response was, no, what happened didn't fit my conditions. And if it doesn't fit my conditions, I'm out. He doesn't have a backstory. Okay? He has a story of, this is the edge. This is what constitutes my edge. If it doesn't meet the conditions of my edge, I'm out. He's not waiting for the home run. He's not saying, I can turn this trade around. I'm just going to get some money. None of that. And he's the guy, he's the guy with the house in Connecticut. He's the guy with the airplane, the boats, and blah, 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 blah. And he's a great, nice guy. He just has learned to create rules, follow them, and recognize the moment that you leave those rules, when you have them sitting over the randomness of the markets, the moment that you leave those rules, you're gambling. And what you'll discover in retail trading is that most people, even though intellectually they know that, geez, I know that I need to be able to take good losses. But when they're in the act of being there and capital at risk, they look at something and they want to make it turn around. They don't lose it. And you're recognizing that's the demon right there. That's the part you have to master. This stuff that you read about, that I'm going to train my subconscious mind by repeatedly doing all this stuff with all these visualizations, all these affirmations, that works until you hit pressure. That works till you hit stress. And then the old survival patterns kick in. The key is you have to be able to go in and start really, and this is where your trading account actually becomes your best friend. It's brutal, okay? I acknowledge that it's brutal. But what it's doing, your trading account is revealing the effectiveness of the beliefs that you have about managing uncertainty that you are projecting onto the markets. And you're seeing it in your trading account over time. And the hardest thing in the world is to get the trader to look at the trading account as a truth meter and to start saying, well, what are the beliefs? And these are not beliefs that you have in a thinking way. These are not beliefs that you just say, yeah, I believe in God, country, and blah 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 blah, whatever, all that kind of stuff. No, what you're looking at is literally at the level of the foundation. Your emotional brain does not operate in language. Your thinking brain, that's the one that does all this talking inside your head when you're trading, would love to believe that it's in control. But what's in control is an emotional brain who doesn't think as we understand thinking. What it's doing, it is literally coordinating how to act with the environment for survival. And it's happening on what we would call a subconscious level. What advertisers know is 95% of the decisions you make are not conscious. And what they do now is they have all this, the eye technology and stuff like that. And what they're doing is they're going in, they're videotaping people. They're not listening to what they say is behind their decisions. What they're doing is they're watching the body as it engages the stimuli out in the world that the advertising agency is trying to sell. That's how it's done. It's kind of like I'm from the advertising industry. And many years ago, I worked on a Mercedes account. I was looking at this and I came upon this really curious number. And this is in the 80s. Okay, so this is years and years and years ago. Do you know what the average cost of a repair on a Mercedes was in the 1980s? Over $1,700. And I looked at it and says, how can people desire status to such a level that they'll be so stupid as to spend a minimum of $1,700 on a repair? And that would include like getting a tune-up, having an oil change, and stuff like that. And you're going, my God forbid that if you have something serious. But that was the need for status, and you don't see that consciously. Okay, you don't see that consciously, but there it is in operation if you're looking for it. And in trading, what you're doing, you're saying, I need to get beyond my need for adequacy. I need to get beyond my need to matter, because most guys are trading really as a way of proving they matter. If I make a bunch of money, then I'm going to matter. I'm going to be a big deal. And giving that control to the trading gods is one of the silliest things that you can possibly do, because it's random. The other one is basically proving your worth. And I've literally had numbers of guys who are able to build net worth up to a particular moment, and once they reach that moment, they start losing it back down. What there is there's a belief behind that level of net worth that locks them into that. And the key is that I see it in the trading account. Now let me expose it as basically something the limbic system did that was very adaptive. That's why it's there. But the problem is, when the limbic system is wiring in a knowing, a belief, you don't see it, but it's simply a knowing of how you interact with the market. And when it triggers, if thinking is in the way, the thinking is just simply pushed away, unless you know what to look for. And most people don't really use their trading account as a detective. And they don't look at these four principles: the adequacy, the mattering, the worth, and the powerlessness. They don't look at that as every human being goes through that. That's what the limbic system is organizing you around. It's those four principles. And it's those guys who grasp that and start changing literally the brain of what they learned as they engage uncertainty in the here and now, those are the guys who become consistently profitable.
Incredibly powerful vehicle for self-growth. I mean, on the one hand, you have to learn how to tolerate discomfort. That's the basics, right? The discomfort of waiting, you may miss out. The discomfort of being in a trade that's working, but it's starting to stall out. And you don't know if you should book all your profits now or let some ride, or what do you do? All of the discomforts, right, that we face, that having to book a loss and then it turns right around and goes back in your direction and maybe goes to where you thought it was going to go initially, and you're not on the trade after you book your loss. All those forms of discomfort are normal parts of trading. And the traders who are the most successful are the ones who are able to tolerate those forms of discomfort. And to tolerate that takes a lot of growth, because we're not equipped to tolerate losing and missing out. The brain's not wired for that. And then the other aspect of the self-growth, I mean, there's many aspects. The other big aspect for me is it really helps me to understand who I am as a person, so I can become the best version of me. I can't trade like someone else. I can only trade like me, but I can be the best version of me. So that requires learning about my intuition, separating that from my emotion, how to distinguish the two. And so there's so much that one can do as a trader that generally will translate into self-growth if you do it the right way. And when we're facing risk or uncertainty, or both, we're usually facing both at the same time, the brain's job is to keep us alive, not to think, is to keep us alive. And so what's going to happen is all of a sudden we're going to be in a state where our survival is on the line, not just our financial survival, but our sort of our ego, our self-worth is on the line. And so it's learning how to tolerate the assaults on our ego, on our sense of self-worth, who we think we are, who we want to be. And there's a lot of discomfort when the market's not doing what we want it to do. It takes some real effort and some really deep work to do that. There's a lot of stuff out there in trading psychology that I'll just say frankly is nice sounding, but it doesn't work that well in the trenches. And I'm all about what works well. What sounds good may not be what actually works. One thing that I can share with your listeners and viewers that will probably help to some degree, it might help some people a lot, and this is an eye-opening experience that many of my retail clients will have, is when I share with them that, and I might even use a very specific example, or I might talk about it more in generally, about a professional trader who is going through the exact same experiences, the exact same emotions, I should say, anxieties, frustrations, whatever, but they're just reacting on a behavioral level to those emotions differently. It's the only difference. I think a lot of retail traders think you're supposed to be cool and calm and not be bothered, and you're a warrior and all this that's kind of BS. There's moments of that, but in general, a very successful trader, professional trader, is going to be pretty much experiencing the same stuff that an unsuccessful trader is going to be experiencing. They're just reacting to it differently, behaviorally reacting to it differently. And when people hear that they're not actually that different on an emotional kind of a level in terms of their experiences, it often helps. It's like, because they think there's something wrong with them. They often think they're defective. There's something wrong with me, that I have FOMO. Well, you know what? The greatest traders in the world have FOMO. It's just they don't act out on it as much as someone else does. We are primarily emotional creatures. Neuroscience has shown this for a number of years. I've been talking about it for a long time, that it has been verified by a lot of neurobiology experiments. But the brain creates emotion as a way to attend to all the information that's coming in. We're getting a zillion bits of data, olfactory, kinetic, visual, auditory. It's a lot to process. One of the roles of that creating emotion does for us, having emotional experiences, it directs our attention to things. It's part of that survival mechanism that a lot of people talk about in trading psychology. So that evolutionary thing. So being able to understand how that works is a really important first step in trading psychology. It's not going to be enough to change one's behavior, but you have to first get your arms around those concepts is a really good first step. Risk management. Most retail traders, majority of them, not all, but I'd say, and this is anecdotal based on all the emails that I get, people reaching out to me who have problems. I don't know most of these people, but I see their emails. more than 2/3 of them are risk seekers. They don't have good, they talk about things like, I've got a good strategy, but I can't follow my plan. I have these impulse trades, or I have a hard time accepting the loss. So that tells me they're not good risk managers. They know how to make money. Most traders know how to make money. Making money, locating the opportunity, is the relatively easy part of trading. I could teach my 10-year-old neighbor to do that very easily, probably in a couple of days. The hard part is risk management. So that's what separates often the professionals from everyone else, is their focus on risk management, because that's their job. It's their job on the line. This is what's so tricky about trading, is that, the market lulls us in. We look at our trading screens and there's price movement. We hear stories, we're on Twitter, or there's always somebody that seems to be making money, or we see some opportunity, that's some movement that in our mind equates to profit. And so most people who are attracted to trading, pretty much everyone, what leads them into it is the opportunity, which is understandable and it makes sense. And that's really the way it really should be, actually. But then we need to have this idea of risk management that should go right along with, yes, I'm an opportunity seeker, but I'm also a risk manager. In fact, what it really needs to be is, when somebody who's not a trader asks me, like, what is trading? What is it about? And I tell them, well, first of all, I say, you probably, think twice before you want to do it, because it's going to be harder than you think. But the next thing I tell them is that really what it is you need to simultaneously do two things that are that don't seem to go well together at first, but eventually they do go well together. But what those two things are is you got to be able to simultaneously identify opportunity and manage the risk at the same time. Most people are going to struggle with that. Most people are going to focus more on the opportunity side. And you get about 30% of the retail traders out there, roughly a third, who are more on the risk averse side. And they're really overly focused on the risk management. They have a hard time pulling the trigger. They get out of a trade at the first sign of heat. They get out too early all the time. And so there's that too, but that's less, the overly risk managing. I'd say it's roughly about a third of the retail folks out there. And the other 2/3 are overly risk seeking and focusing on opportunity. It's what I see.
Technical skills, you can't just read a book or go to a seminar. You really need to practice it. And I know traders get very uptight about this when I say, well, you got to be doing a lot of practice trading, get some data, historic data, get some software that can do bar replay and do one bar at a time. Oh, but it doesn't have money behind it. I tell them, if you are letting that thought dictate how you're going to how you're going to prepare for trading, then you've got a problem right there, because you're letting thoughts dictate good practices. So that's one thing, is to practice your trading. Every athlete I know, for example, professional level athlete, they're practicing all the time, day in and day out. They wouldn't think twice about setting foot on a playing court or a playing field without having a game plan and practicing. So that's really important. That's number one. But okay, setting that aside, there are two things that you can do to improve your mental game. And the first thing is to keep a trading journal. And I'm not talking about how many trades you won or lost, how many points you made, or your win-loss ratios. Those are important, but I'm not really interested in that when we're talking about psychology. What I'm interested in is your performance. And there's 3 simple questions that you need to ask yourself at the end of if you're a day trader, at the end of every trading day, for a swing trader, at the end of every trade. What did I do well today or in this trade? Where did I fall short? And what can I do to stop falling short, to start improving myself on that? Okay. And really what we're looking for here is patterns. So if you're, for example, hesitating to pull the trigger on taking a trade, and you see that as a pattern, trade sets up really good, but we're not able to pull the trigger. I see the entry, I know where my stop is going to be, I got a target, all of that stuff, but I can't pull the trigger. That's mindset. That's your mental game, right? Okay, so now on the mental side, there's a really important thing to start to learn and to practice, and that's meditation and mindfulness. Meditation is the formal practice of mindfulness. Mindfulness is the application of it and the informal practice of it. Basically, they're synonymous. What mindfulness or meditation starts to teach you about is really important in this trading game. First thing it teaches you is that our thoughts come and go on their own accord. We don't have a lot of control over them, right? Think about it for a second. What you were thinking about earlier today in your lives, if you're listening to this, whatever you were thinking about, it's different than what you're thinking about now, right? What happened to those thoughts? It's just natural that they come and go. They constantly do that. Second thing that mindfulness teaches us is that thoughts are impermanent. They're temporary. They do come and go on their own. We don't really have to do anything with them. There's a lot of thoughts and feelings that are generated by thoughts that we don't like. Oh, I'm going to have a loss. It feels very uncomfortable. I feel the stress, muscle tension. My body's sweaty. My hands are sweaty. I feel tingly and numb. My mind's racing and all of that. You're caught up and you're about to get emotional, or you're in the throes of emotional hijacking. But you don't have to get to that point. You begin to recognize that thoughts they come and go on their own, and they're impermanent. We don't have to respond to them as if they were commands that we have to do. Third thing is that most of the time, especially in trading, when we're in the throes of stress and anxiety, most of the time those thoughts are going to be inaccurate. Why? Because the mind is kind of making it up as it's going along, right? It's saying to yourself, oh, but if we get into that trade, it's going to there's a good potential for a loss. Maybe you don't want to take that trade now. And then what happens? The trade goes off and makes all the points you had in your target, right? So a lot of times these thoughts are really inaccurate. And what's accurate is our trading plan, not the stuff that's going on in our heads during the middle of the day. And then the final thing about mindfulness is that it's helpful to recognize that these are very natural. Everybody has these thoughts. There's nobody who's ever walked the face of this earth going all the way back, and I can predict going all the way into the foreseeable future. There's no one who hasn't had wacky thoughts like this, who hasn't been stressed, hasn't felt fear. This is all natural. These are not abnormal feelings. They're misapplied in trading, yes. But if we didn't have fear, if we didn't have stress, we'd be running around bumping into all kinds of things and putting our hands on hot plates, repeatedly over and over again. The fear is there to help us learn, and it's very important. We can't get rid of it. And trying to suppress it is also a very bad idea. In fact, we have more of it when we do try to suppress it. So really, the things that you can do: practice trading, start keeping a trading journal, not on your trade points and win-loss ratios, but on your performance. And I gave you 3 questions. And then start learning about and practicing mindfulness and meditation. I do it every day, at least 20 minutes to 30 minutes a day, and often I do it twice a day. And I found it to be the most powerful technique, most powerful mental skill to build, not just in trading, but in life in general. This comes from people experiencing a series of losses, most likely because they haven't spent the time learning their technical analysis and practicing it, right? So they get into the market and they're not very skilled at it. And of course, they're going to have losses, and some sizable losses, right? And so they get afraid of the market. In fact, I had a person who, every time he sat down in front, I put it was a biofeedback kind of machine on him that measured heart rate, skin conductance, sweatiness on skin, blood pressure, that sort of thing. And as soon as he sat in front of his trading screen, his computer screen, his blood pressure shot up and his heart rate elevated. He got all sweaty and all of that. He was what we call conditioned to become fearful of the market. And this is exactly what happens. So what's conditioning? Do you remember Pavlov and his dog experiment from, I don't know, high school or college, right? Pavlov actually I think he was a physician, and he was working with salivation in dogs. And he noticed that every time he brought meat before they started to eat, it would trigger salivation in the stomach and in the esophagus, I guess. But and he was curious about that. He said, "Oh, I didn't realize that happened. I thought the food had to go in there beforehand." But this, and Pavlov was a curious guy. He said, "I wonder if it's totally outside the experience of a dog, like a bell, right? And if I rang that bell before I fed the dog, what would happen?" So he did that. He rings the bell, gives the food. Rings the bell, gives the food. Does that a few times, right? Then just rings the bell. No food. What happens? The dog salivates to the sound of the bell. Taking something totally extraneous and bringing it into the environment and now making it a factor in the dog's minds. Right? When the bell rings, food must be coming. Let's get prepared. And the body says, let's get prepared and salivate. Okay? Well, this happens in humans as well. If we've had a series of losses and a couple of sizable ones, when we see a trade setup, what's going to happen? We're going to, just like Pavlov and the dog, the bell is going to ring. And we're going to feel what? Stress and anxiety and fear about loss. We've conditioned ourselves to become fearful at the sign of a trade setup, just like Pavlov was able to condition the dogs to the sound of a bell. Okay? So, this is this is it right here, right? This is the thing. And what we need to do is we need to decondition. And again, mindfulness is going to be the real key factor here, to recognize that these thoughts and feelings, and I've got various methods and techniques to bring people through surfing, for example. Part of this is tolerating the unwanted feelings and thoughts. Because if we tell the mind, hey, look, I really don't want to feel fear here. You know, I don't want to feel stress. I want to be cool, calm, and collected all the time when I'm trading. So I don't want to feel stress. And the mind takes that on as like a good little soldier and says, okay, no problem, Gare. I'll make sure that you don't have stress. So what does the mind do? Well, it's out there kind of guarding, looking around, scanning out there for scanning the environment for stress. And as soon as it sees even the slightest amount of something to be concerned about, it brings it right to our attention. And what happens? It creates anxiety, right? It creates stress. So the thing is, the more we try to suppress these thoughts and feelings about fear, the more we're going to have them. It's a paradox in psychology, but it's true. The mind starts working as a sentinel and calls it up to us. So what we really need to do is start to understand our thoughts and feelings and start to get a handle on them. And instead of believing them wholeheartedly, oh, I could have a trade sets up and now we're projecting out into the future, I'm going to have a loss. Well, we don't know that. Right? So instead of locking in and believing that uncritically, we start to develop a mindful approach to it. And we start to see those thoughts come and go on their own. Yeah, I'm having a thought that it could have a loss, but this is a good trade setup. Right? So we want to take action towards the thing that's important to us. And if trading is important in making money, and we know that trading and making money is best done according to a trading plan, then that's the way we want to trade, not randomly either jumping into a trade because the mind is telling us to do so, or hesitating and not pulling the trigger because the mind is telling us not to do that too, due to fear of loss. The way I think about it is that you start with some amount of capital in your account and you want to grow that. And that we should earn the right to grow that rather than, and that might involve new funds coming in, especially if you're an individual trader. I mean, if you're in a firm, you don't have control over that. I'm talking now from an individual retail trader's perspective. My suggestion would be to start with a given amount of capital, keep your risk really low. Risk management is a key consideration. In trades, I recommend like between 1.5% and 3%, especially in day trading. And most of my trades are between 1.5% to 2.5% risk. And sometimes, sometimes that means $1 risk. You can't really tuck it underneath support or resistance, or you don't take the trade. Let me think about where I want to go with this. So starting with a certain amount, and then keeping your risk parameters low. But there's two sides to risk, Most folks think about the money management side, the risk side of I have to put a stop in the market and I can only risk a certain amount, 1.5% to 3% per trade. But there's another side to risk management, and that's stepping up size when appropriate. Example, trend days. We had a couple last week on Thursday and Friday. Market came down in the S&Ps. The market came down hard, and they were spectacular trend days, and great. But we don't get many of those, right, in a given month, maybe 2, 3 in a month, something like that. And they can really make your month, and if you trade them well. So being able to step up size when the conditions are ripe for it, like on a trend day, and you can still trade in and out of the swings, but keep a core position on, right? That's really important. That's once you get to a point where you're a skilled trader, that becomes really important to be able to do. So it's not just about keeping risk intact. It's also about knowing when to step up size. And then there's a third component to this, and that's earning your way to increased size. People, if they start off too quickly, and this doesn't really matter how much money you have. I have clients with, retail traders who have very little amounts of money and they're trading micro contracts. I also have a couple of very wealthy investors, and I mean really wealthy, and they put on 500, 700, 800 S&P contracts at a clip. So they're trading in that kind of size, right? But no matter who you are, no matter how much money you have or don't have, there's a limit to that. For example, if I put let's say an 8-inch by 8-inch beam, 50 foot in length, and I put it down on the ground and I said, okay, let's walk across that. You and I would have no trouble doing that. If we put it up 3 feet off the ground, probably not have much problem with that either. If we put it up, say 25 feet off the ground, we'd start to have some difficulty. And if I put it up 50 stories high, right, down in downtown Manhattan across 2 tall buildings, we'd be really hard pressed to be able to do that. It's the same thing in your allocation and in your position size. You want to earn it. And I think the way to do that is to do it gradually over time. Build up your own account. Try not to take money in from outside. Build your own account up. And as you develop, margin is a good way to do this. You can, once you go from, let's say you start, just to keep things really simple, let's say you're trading in the S&Ps and you start with an account of $10,000. You trade over the course of a month or so, and you bring that up to say 4,000, 5,000. That's probably enough margin. So now you can trade 2 contracts. Okay. do that for a while, build your account up another 4 or 5,000 on the margin. That now you can trade 3 contracts and so on. You can actually do it pretty quickly. Within a few months, you can get your size up to a good size. But that's a gradual way to do it, which isn't going to wreak havoc with you mentally and psychologically. You know, everybody I know or knew who, because they're not trading anymore, who wanted to make $1 million by the end of the week, weren't successful. This really is a difficult thing to do. And, you know, let's take it out of trading. Look, I'm a tennis player, right? I've been playing for, 20 years or so. And I'm okay at the club level, but I'm not able to play at Wimbledon or the US Open or the French Open. I'm not at that level. That's a lot. That's a big step up, and it takes time to get there. These tennis players, to play at that level, start off at, 10 years old, 8 years old, and they're going through, and the same with any sport. What we're talking about are skill development. We're talking about skill development. You've got to have skills to trade in the markets. It's that simple. And skills take time to develop. Think about creating a golf stroke for yourself, right? And there's multiple golf strokes. You chips, putts, drives, and probably others. I'm not a golfer, so I've played it a couple of times, but I don't really know. But think about it. You really have to put time in on the golf course to practice, and on the driving range, and on the putting greens and do a fair amount of practice before you get those strokes down to the point where they're halfway reliable, right? And then if you want to get to the pro level, you got to put in an enormous amount of practice. So, it takes time. People if you're looking for a simple solution, you're looking for a quick and easy, get a software and the app can ding me when there's a good trade and all I need to do is press the button and I make $1 million. Yeah, good luck to you, pal. Let me know if it works out, because we'll all be interested.
Discipline is one of those things that everybody likes to talk about it. And it sounds, we like to be very macho when we talk about trading, and discipline sounds really strong. And it sounds like, of course, you just have to have ironclad discipline. And I think you're absolutely right. The reality is that if you have trouble with discipline, it is many, many times a symptom of something else. And the other thing that, on the discipline topic, one of my mentors said this to me. How I think at the end of your trading career, you'll look back and there will be a few things that stand out. And, maybe, I don't know what, like half a dozen things that people have said to you. And this will be one of the things I always remember. He said to me, Adam, if you're not disciplined every instant you're in the market, you can't say you're disciplined. You can be a disciplined trader. You can do 40 trades in a row and do exactly the same thing. And then, I know where my Achilles heel is, and it's that I tend to take profits too early. And that goes way, way, way back to my initial formation as a trader. And it's something that I have defeated that. That's not a problem that I struggle with now, but I know that's probably what I'm vulnerable to. But so, I know I could do 40, 50 trades. And then on one trade, I get a little nervous or I'm having a bad day and I take that profit early because I don't want to see the profit go away. I'm not a disciplined trader. You have to be disciplined every moment, every instant of your interaction with the market. And that's not, that's something to aspire to, but I think a beginning trader can't possibly hope to do that. And that's just a symptom of all of these other things that are, going on as all the pieces of their trading fit into place. Well, the solutions are so simple that you would not believe they would work. One of the things that I found to be very effective with traders is you put a rubber band around your wrist, and when you are about to make a mistake, It's a pattern interrupt. When you're about to make a mistake, you snap the rubber bands, you hurt yourself a little bit. It's not like, you know, you're whipping yourself or anything, but the pain of that rubber band just before, like, you know, if you, let's say for instance that your weakness is you cancel stops. A lot of traders do that, right? It goes down to your stop, and then rather than getting stopped out, you're going to cancel the stop. And we know this is one of the very dangerous ways we can destroy accounts. So, you know, what I would tell a trader is, okay, you can do that, but before you do that, snap the rubber band. And what you will find almost every time, the act of doing that just wakes you up enough to say, hey, I'm about to do something stupid. I'm not going to do that. I'm not going to push the button. So that kind of pattern interrupt can be a very powerful thing. Another thing that can be very effective, visualization is a powerful tool, but you have to use it correctly. And one of the best ways I know is to imagine a situation that causes you a lot of anxiety. So it could be, for instance, where that market is ticking down to your stop. We've all been there. I've been there several times today. And, you know, how do you feel as it gets closer to your stop? So what you can do is, away from the market, you can sit in a quiet place. You can call it meditation if you want. You can do it. You can lie in your bed before you go to sleep, and you can imagine putting yourself in that situation. And then what I would encourage you to do is to create that physiological stress response. Make yourself breathe really fast. You know, how do you breathe when you're scared? You breathe shallow, you breathe fast, and it affects the chemistry, the pH, and, you know, the balance of all the gases in your blood. And so make yourself do that. And what you can do is, away from the market, you can replicate the stress of coming down. You know what, I'm using the stops just as an example. Whatever stresses you out. For some traders, it might be taking an entry. It doesn't matter what it is. And then what you do is change your breathing to slow, deep, and relaxed breaths, and see yourself taking the right action there. A day of that, simply doing that exercise, you know, takes maybe half an hour if you do it with intention. Do it a few times. It can have a profound effect on behavior. Another thing, you know, what has worked for me over the years is different things work for different people. But for me, my self-talk is very brutal. Like, you know, I will always, you know, I'll say things to myself like, you know, you're really a fucking idiot, which is not, you know, if you're going to do that, are you stupid enough to do the same? And you could, you know, what I'm describing in the wrong context could be a very destructive thing. It could, you know, could be a spiraling cycle. But for me, my reaction to hearing myself say that is I kind of get angry at myself, and I say, no, I'm not that stupid. I'm not going to make that mistake. And so, very aggressive, and, you know, it's almost like I joke with myself, I guess, but very aggressive, very negative self-talk breaks me out of things. And the way that it was a persistent problem, 20 years ago when I was trading the S&P, that I would take my profits early. And the way I got out of it was, at the end of the day, I looked at every trade, and I simply made myself feel really bad every time I did it. And I, you know, eventually got the message, kept telling myself, if you keep doing that, you're not going to be a trader. So you just know you have to change your behavior if you're going to stay in the game. A lot of different things for different people, but those are some things that work for me. This is the first time I've said this to anybody other than like 2 or 3 of the traders who are closest to me. So this is the first time this is going out in the world. One of the concepts I think that makes trading difficult is that one of the things that makes it difficult is that if we act like normal people in the market, like good, normal, sane people, we're not going to make money, because the market is kind of a pathological environment. You have to do what seems and feels wrong. And I have found over the course of my career that a lot of times the areas that are causing me the most pain, that's what I should gravitate to. And, you know, in normal life, we use pain as kind of an away from thing. But I think in the kind of, twisted way the market turns our own cognition, our own tools, our own emotions against us. And I really do think that's what the market does. The market is not random things moving around. The market is the changes of every market. The price changes are created by, it's a war, people fighting it out. And so those price movements encode human emotion, which means when we expose ourselves to them, particularly when we put on risk and those price changes do things to our trading accounts, it's I don't think it's a fully understood linkage. There's been some research showing that people can intuit intent, and intuit's not exactly the right word, but they can perceive intent. They can, tell when there's a manipulative trader in the market, and we feel this on some level. We feel this on some animal level, I think. And in this environment, a lot of times, what is our pain? What is our fear? Is actually something we should be going into, we should be digging into. And some of the real gems I have found in my trading experience have come out of not I wouldn't say face your fears. I wouldn't say make your fears go away. I would say go into your fears. You use them as like this beacon of, this is an area you need to explore more. And eventually, the charge of all of this, I think, for those listening who are newer traders, part of the answer to all of the emotions we feel. I could tell you about my first few trades. I will if you want. That's kind of an interesting story. But all of these crazy emotions you feel do go away with repeated exposure. You get to some point after you've done enough trades that you're just like, it's just another fucking trade. Like I'm not so involved with it. It does get easier, but it's this just this torrent of emotions for developing traders. When the market punches you in the face enough times, you start to get the message. So trading for a long time is one way to become aware of our fears. The other one is cultivating this awareness, sitting down, doing some journaling, and say, these are the aspects that are really difficult for me. And let's say, for instance, that this is not at all how I trade anymore. And we should talk about the 0.5R profit targets. I saw you interacting with somebody in social media about that, because that's also something that we've been looking at a little bit too. But this is not how I trade. But let's say that you try to get these like gigantic wins. You try to get like 10, 15 times your initial risk. It can be done, just not very often. You can do it. And let's say that, because I'm thinking of a specific trader I worked with who had this struggle, and he would, once he got beyond like 5 or 6R, he started to get very nervous. And I'm sure most people know what I mean by R, but it just means 5 to 6 times your initial risk in the trade. So then he had very precise rules, trailing stop rules, that would get him out of a trade on a specific retracement at different brackets. It was well thought out, but he had difficulty that if there was a single bad day, he was trading on the daily chart, he would just get out kind of randomly if it was over like 5 or 6R. So what he had to do, once we had identified that was a problem, he had to, when he was in that situation, really become very aware of his feeling. And then that's your chance to say, okay, now, it's one thing that we've done all of this, navel gazing, which is, I guess kind of a pejorative term, but, we've done all of this like classroom academic work to figure ourselves out. But now you're standing in the arena, and there's a lion in front of you and you have a spear in your hand, and it's quite a different thing. And there's no other way to replicate that except to be in the live market and to have risk. Now, the problem with this particular trader was he was swing trading on a daily chart, and he really did not have that many trades. He had a handful of trades a month. So this is one advantage intraday traders have. he had to go many, many, many months before he could be, and of course, trading like that, you could trade for many months and not have a single trade go over 5 and 6 hours. So he had to work for a long time before he was in a position where he had a trade that had 8R, and then the thing had a bad retracement on a single day against him. And, now what do you do? But because he had done all of that preparation work, he was able to act correctly. And the first trade happened, of course, it collapsed, and he would have been better off following his instinct. But that's also a good lesson from the market. The universe kind of throws us humorous curveballs like that. So I think it's I know it's kind of a complicated answer, but you really have to identify where your fear is, and then you have to actually seek it out, and you have to spend some time with it, and then you have to figure out how to shape your action, and all of these other tools come into play there. There are things that we know we're good at. So this is going to sound arrogant when I say this, but one of my trading skills, I'm really good at trailing stops. I'm really good at setting trailing stops. And so what I would always do is take small profits. I would be aware of, here I'm at 1R, here I'm at 2R, I'll take some off. And I had this one glorious trade over 10 years ago. I still remember this. I made over 30R on a piece of a trade. It was a euro trade. Now, the problem with that, though, was that I had taken profits on that damn thing about, I don't know, 8 times. So I made 30R on a very, very, very tiny piece of the trade. It was not much money at the end of the day. However, several things about that. When you have a trade like that, even if you have a small position on and it's a big R ratio, you're going to pay a lot of attention to it. And this is one of the dragons I have killed, but if I had not, I still remember that trade. It feels really good to make 34R on a trade. You feel like you're the king of the world, and of course, your brain very quickly forgets. Oh, I made 34R on like 1/10 of my position. So I think it ties up too much of our too many mental cycles on these smaller things and smaller pieces. Many years ago, 5 or 6 years ago, I don't remember exactly when Tom and I started trading together, he was looking at my results. He said, I think you might do a lot better if you took all of your profits at 1R. And I said, that's the stupidest idea I've ever heard. What a ridiculous thing. I'll almost always, it's not true, but my brain said that I'll get like a little bit off at like 3 or 4R all the time. And he's like, well, okay. And then, so we kind of let it sit there. And then I went back and I did some, pro forma. It's quite easy to look at your trading results and say, what would have happened if I took the whole thing off at 1R? And what I discovered was 2 things. So the first thing that we should not ignore is all other things being equal, a smoother equity curve. An equity curve that goes like this is better than one that goes like this. So if you end up at the same place, if your equity curve has a lot more ups and downs, well, the smoother curve, one thing you can do, you can apply more leverage. You can take more risk. You can trade bigger. Again, all other things being equal and assuming that all the assumptions hold in the future, which is not always true, but it's a mental disclaimer that you always have to have going on. So it did smooth out the equity curve as expected. However, the other thing that just shocked me, it didn't surprise me, it shocked me, I would have made more money. So I would have had a smoother equity curve, lower standard deviation of returns, and a higher ending equity. And so we looked at other periods and other accounts and, like even records that I published publicly of trade setups and that it had trailing stops. And we looked at them against a 1R target, and there was no doubt The 1R was over the top, consistently better. So then you think, okay, well, like maybe 2R is a little bit better. That has not turned out to be the case. And this is one of the aspects of trading that I get the most pushback on from the most people. One of the pieces of feedback I get from them is it doesn't make any sense. They say it doesn't make any sense to use a 1R target. I said, well, okay, I thought so too. I understand where you are, but before I did about 200 hours of work by hand, I thought the same thing. And, now I've seen the results.
I'd say it's the same reason why newer traders aren't able to spot opportunities in the market, right? The price action moves too much, right? Zones change, like the profile of a particular trade can change so fast. But as you become more experienced, right, you can sort of see it even kind of before it's coming, or have an idea that it's coming. And the same thing is true mentally and emotionally. And that's why I have my clients, why in the mentally emotional trading, like the mapping of your pattern is such an essential kind of component here, because you have to be able to create the data points that tell you probabilistically that you're likely to go on tilt, right? That you're likely to get angry and do something dumb, or you're that the fear is rising and you're likely to close a position early or jump in prematurely. I mean, again, it's not causal, but probabilistically, like, we can understand certain tendencies within our emotions and recognize the data points that indicate them. And I'll, give you one from the book, which I think is quite distinct. A client who would tend to get greedy recognized, and he was a swing trader, right? Recognized that as soon as he opened up his brokerage account to see what the running P&L was, he knew that his mind had begun to get greedy, and he was quite literally like several steps ahead, or several steps away from actually making a mistake that would materially impact his trading. But that was the first indication that he had now kind of deviated from an optimal state of mind, which didn't care about the running P&L. He's like, he knows where there are certain check marks that he's going to start to scale out. And until that alert comes through, there's nothing to do, right? But the fact that he's now thinking about that open P&L means that he's begun to get greedy. So it's like being able to kind of have that self-reflection to say, all right, I tend to jump into positions prematurely when the market's ripping and I'm not involved. So are there any kind of precursors to this? Like, does it matter if you had a losing day, previously? Does it matter if you're in a drawdown? And if you are, well, then you have to be prepared, because any given day, like, the market can rip. And so at the start of that day, you're preparing yourself. All right, you're in a drawdown. Be aware, if the market rips, this is what you're going to do, right? You're going to sit on your freaking hands until you get confirmation. And you have to understand that if you're able to do that, then you got one data point in the position of progress in being able to gain more command of your decision making and ultimately being more, quote, disciplined. But really, you're just at that point kind of managing the emotional volatility better. It's not bad for a basketball team to look at the scoreboard and see where you stand, provided that it informs you on, like, what you're going to do next. Like, all right, we're down by 15. We need to actually kind of change our game plan. But if we're up by 30, like, you don't want to change your game plan too much, because that's where. So here, if you start looking at your open P&L, is that informing you on what you're going to do? Does it feel like you've already kind of won the game, even though the game's still open, right? I think that there's an attachment to that open P&L that makes it feel like it's yours, or you feel really down if it's negative, and then your emotions start to maybe look to manipulate something. You maybe look to get into another trade to try to make up for something. It's I think very difficult for traders to see, and I use the basketball analogy again. It's difficult for traders to see that, like, singular trades are like the equivalent of like one play in a basketball game, right? It's not one game. If you lose this trade, you win this trade. It is not, oh, I won a basketball game. It's no. You had a turnover, made a bad pass, or missed a shot, or you made one, made a great pass. It's like singular moments in the scope of a long game, because as traders, to play the equivalent of a basketball game is what? 60, 90, 180 days, depending on how many trades you're taking depending on your style. Like to really be able to realize your edge, it's just not like so. It's I think a challenge to kind of view it that way, but it helps to change the nature with which you're like connecting to P&L and looking at P&L, because in an intraday basis, it should just be informing you on what adjustments to be made. And if that is not happening, then it's an irrelevant data point.
All right, so I really hope you like this 1 hour masterclass here. Hope there was a lot of value. I'm sure there was a lot of stuff into this. I've watched it myself multiple times while I was doing this. Make sure you leave a comment below with your favorite advice. If you want to see more of these 1 hour masterclass, comment below as well, let me know. I would love to do more of these if there's a demand for it. Make sure you subscribe if it's not done yet. I post videos like this 3 times a week. Next one will be coming soon. And if you want to watch more interviews like this, check out this video right over here. It's one that YouTube think you will like. And I'll catch you back here in the next video pretty soon. Ciao.